You know, in the high-stakes world of AI, there are really two ways to get to the top. You can burn a ton of cash to grow as fast as possible, or you can build a lean, super efficient machine. Today, we're looking at two companies with wildly different playbooks: the established giant, Veritone, and the nimble newcomer, BrandPilot AI.
So here's the big question we're tackling today. We're going to dig right into their financial DNA to see what it really tells us about how they plan to grow, how much risk they're willing to take, and at the end of the day, what their vision for the future actually is.
All right, first up, let's get straight to the headline numbers. This is where we're going to get our first really dramatic look at the sheer scale and operations of these two companies.
And wow, right out of the gate, you can see this is a true David versus Goliath story. Veritone's market cap on the left is over 130 times bigger than BrandPilot's. I mean, that just immediately establishes Veritone as the massive, heavyweight player in this matchup. Okay, now let's look at a key number for how a business is actually doing: EBITDA. Think of it as a company's earnings before you get into all the fancy accounting stuff. And what's fascinating here is that, yeah, they're both losing money, but look at the scale. Veritone's losses are almost 20 times greater. That's a huge tell, a clear sign of a high-burn, growth-at-all-cost strategy. But this is where it gets really telling. Let's talk about cash. Just look at these numbers. Veritone is burning through more than $46 million. Meanwhile, BrandPilot is, well, it's at zero. They're basically maintaining a neutral cash flow. This is a massive difference in strategy. One company is spending like crazy, probably on expansion and new tech, while the other is just operating with incredible financial discipline.
All right, so those big, splashy numbers tell a story about size and spending. But to really understand their stability, we have to pop the hood and take a look at the engine. Let's dig into the nitty-gritty of their financial health.
So this chart for Veritone shows us some key health indicators. We're seeing pretty solid metrics all around, but the one I really want you to zoom in on is that middle bar, the current ratio. It's sitting at a pretty healthy 1.3. So what does that actually mean?
Think of it like this: if you had to pay all your bills for the next year, your rent, your car payment, everything, do you have enough cash on hand to cover it? That's what the current ratio tells us. Since Veritone's is 1.3, it means for every dollar they owe in the short term, they have $1.30 in assets ready to go. That's a pretty good sign of liquidity, even with how much cash they're burning.
And this side-by-side really paints a picture, doesn't it? Look over on the left at Veritone. A big chunk of their assets are long-term things, property, equipment. Now compare that to BrandPilot on the right. Their assets are much more weighted towards the short term. This could point to two completely different business models. Okay, let's switch gears a bit. We've talked money, now let's talk control. Who actually owns these companies? The answer can tell you a whole lot about insider confidence and how easy it is for you and me to buy their stock. Before we get to the charts, we got to understand this term, free float. It's actually super simple. It's just the portion of a company's stock that regular people, like you and me, can actually go out and buy on the stock market. A higher number means more public ownership.
For Veritone, this chart shows that the vast majority of its shares, over 87%, are out there in the hands of the public. This is pretty typical for a bigger, more established company that's been around for a while. But then you look at BrandPilot, and it's a different story. See that? Over 20% of their shares are closely held. That often means the insiders, founders, executives, are holding on to a much bigger piece of the pie. A lot of investors see that as a strong sign of confidence in the company's future.
So, we've looked at the size, the financial health, and who's in control. Now it's time for the final weigh-in. Let's put everything side by side on the judges' scorecard and see how they stack up. This table just lays it all out, plain and simple. Over on Veritone's side, their strengths are obvious. They're big, their stock is widely available, and they can pay their short-term bills. But the cons are a direct result of that. They are burning through a ton of cash and losing money on operations. Now flip over to BrandPilot, and it's the mirror image. They are incredibly efficient with almost no cash burn, but they're much smaller and don't have that same short-term liquidity. So here's the bottom line. What we're really looking at are two completely different philosophies. Veritone is the giant, aggressively spending to conquer the market, and they're accepting huge losses as just the cost of doing business. And then you have BrandPilot, the leaner newcomer that's focused on being financially stable and efficient right from day one.
And that really just leaves us with the final question, doesn't it? Do you bet on the massive rocket ship burning fuel at an incredible rate in a frantic race to the moon? Or do you put your money on the smaller, more precise ship that's carefully and efficiently navigating its own course? In the fast-moving world of AI, only time will tell which strategy actually wins.